Hi everyone, welcome back to the channel where every week I'm going to share some tips about personal finance and investing. So today I'm going to cover a very interesting topic which is investing in the stock market. Now I'm sure a lot of people get excited when it comes to stock market because they want to find the next Tesla, Amazon, or like if you're in Australia, probably Afterpay. However, the investing approach that I'm going to discuss today is actually very different and very simple. Now, before I jump on that, I actually want to share a very interesting story about Warren Buffett's bet a few years ago. So, back in 2008, um, Buffett actually made a bet with some of the hedge funds. So the bet at that time was Buffett said over the long run, like a 10-year time frame, um, if you simply put the money into an S&P 500 ETF, like an index fund, that we outperform the return of the hedge funds, like the large hedge funds managed by professional investors after allowing for all the fees and expenses. And of course, all the proceeds from that bet going to go to a charity, no matter who wins. Um, so after 10-year period, I think the period started from the 1st of January 2008, and the bet concluded on the 31st of December 2017. And in the end, Buffett actually won. So after a 10-year period, the S&P 500 um, actually generated an average return of more than 7%. I think it's about 7.7% per year. While the hedge funds joining in the bet actually generated an average return of around 2.2% per year. So when I share this story with you, um, what I want to say is, over the long run, passive investing, especially in investing in the low-cost index funds, can actually be a very useful strategy, and which can actually help you to outperform a lot of hedge fund managed by professional investors. Now, this might not sound very exciting for some of you because you might think that, well, when it comes to stock market, you want to do your own research, you want to invest in the companies which can generate like 10 times or 15 times of return one day. You want to find the next Apple or next Amazon or Tesla or Afterpay. But look, in order to invest for the long term, um, there are some criteria. There's something that you need to do to make sure that you succeed. The first thing is, if you want to be successful in investing, you really need to understand the fundamentals of the business. So even with the growth stock or the small companies, you really need to spend time researching about the company itself, its products, its management, its operating systems, and its competitors and its competitive advantages and all this. So only if you have a fair understanding about the fundamentals of the business, you can actually invest for the long term. Why that is the case? Because there's a lot of noise in the market, and even companies go through different cycles in their business life. And if you don't have a good understanding about the business and you're not actually buying the business for the long term, when there's some noise in the market and a lot of investors start selling, you're going to get panic. And because you have no idea about the business, you just invested based on some hot tips, um, you're going to sell when the market went down, when the market goes down. And that is the easiest ways to lose money. Now, the second thing to guarantee success over the long run when it comes to investing in stocks is you need to get rid of your emotions. So basically, you don't let your emotions affect your investing decisions. Now, this is easier said than done. It is easier said than done. If you investing in the growth companies or in some sort of small cap stocks, yes, they have a potential to generate a huge returns over the years, but that also brings volatility. Um, Now, when you invest like your hard-earned savings, into this company and you see your net worth go down by around 20%, trust me, it's not easy to swallow that pain. A lot of people, before they invest, they're gonna say something like, well, when the market goes down, I'm gonna sell. But it's not that easy. When it goes down, you tend to wait a little bit longer for the market to recover. But once it just keep going down and down, and you couldn't handle that anymore, you normally tend to sell at the lowest point. And quite often, right after that, you see the stock market recover, and you might jump back in and buy at high prices again. Okay, so now to well, if you're going to give you an example, just think about an example. I think that's Isaac Newton. So basically, I think around 1720, uh, well, Isaac Newton, I hope you know who Isaac Newton is. He's actually one of the greatest um, physicists in the world. So back in 1720, he purchased this company, like the hottest company in England at that time. I think the name of the company is South Sea Limited. Uh, Now, he purchased the stock, and then when he saw that the market was out of control, I mean, it's just so bullish and all that, he actually decided to sell, and he actually profited like 100%, around £7,000 at that time. But after a few, after sometimes the market kept going up, and well, Isaac Newton, even though he's a very smart guy, he couldn't handle that emotions. He actually jumped back in and purchased some more stock at high prices. But right after that, the market actually crashed, and he's actually lost £20,000. So, well, Isaac Newton is one of the smartest men ever lived, and but when it comes to investing, he couldn't control his emotion either. Um, so think about that for yourself in terms of whether you think you can actually control your emotion in those tough times. Now, so the solution Warren Buffett actually gave like advice to a lot of investors when it comes to this issue is just investing in something very simple, which has diversification, um, and which you can you can you're gonna be happy to hold for the long term. So Warren Buffett actually said that one of the easiest way for the 99% of investors uh, is to invest in some sort of low cost index fund which track the movement of the whole market. Um, so the advantages of this strategy is one, you don't need to have a lot of capital to start with. Actually, in order to do really well in this strategy, what you do is low cost. I mean dollars cost averaging. So you start with an initial capital, and then every period of time depends on your situation. Maybe 1 month, 2 months, or 3 months. You just keep buying regularly. Every period of time, and that way, when the market is bullish, you buy less units, and in the market downturn, when the market actually plummets, you actually buy more units. And because you're buying an index fund, we track the performance of the whole market. You don't really need to worry about which company may go bankrupt or anything like that, because the index itself going to rebalance. So over the long run, because the cost is really low with these index funds, and you can actually get rid of your emotions. Over the long run, you tend to perform well, even better than the funds managed by professional investors. All right, so I think that is the message today. If you are new to the stock market and you're thinking of investing some money, then think about the low cost index funds. Think about the example I just gave you, Warren Buffett advice as well. Um, well, having said that, I don't mean that you will never invest in any individual stocks. The good thing about index fund is it is safe, and it get rid of your emotion when it comes to making investing decisions. But of course, the downside is you're not going to generate like a huge return, like 10 times of the initial money or 5 times or something like that. You can only get the market's return. Um, but you're gonna start with something simple first, and when you have more capital, then yes, you may allocate a certain percentage of your net worth into smaller companies. And also time is another important thing. You start, you only start investing in these small cap companies when you actually have some time to do your own research, so that at least you get a fair understanding about the businesses that you're investing in. um, but if you are stuck in a full-time job, you're very busy with your job already, you don't have time to do research, you just get these hot tips from the online forums, and follows all the hot trends and all that, you're going to be affected by your emotion when it comes to making investing decisions, and it is very easy to lose money. All right, so I think I cover a fair bit today as well. I hope this give you some general ideas in terms of how you can start investing in the stock market, which tend to guarantee success over the long term. Thank you for listening, and if you haven't subscribed, please subscribe to this channel, so that next time when I post a new video, that's gonna be delivered straight to your inbox. Thanks for listening, everyone, and have a great week as always. Bye.